Let's talk about Intel's stock today, specifically why it broke through multi-year lows and is currently at levels not seen in a decade. We'll definitely look at the report that triggered such an incredible drop. Of course, we'll examine all the financial indicators. I'll also show you what's happening in the options and derivatives market. We'll be sure to look at the support and resistance levels, as well as the most current data available today. We'll also touch on market forecasts and what the market predicts for this company. Of course, we'll start from the beginning. As we can see, Intel stock dropped by 26% on very high volumes. This is a significant decline that also dragged down the entire market, including Amazon, which saw a sharp drop as well. This led to a significant market correction, but the semiconductor sector, especially Intel, was hit particularly hard. In fact, things are not going well for Intel. As we can see, the company is facing massive stagnation. They've even cut their dividends, which used to be quite good. Recently, they reduced them, and it's important to note that when a company cuts dividends, it's a very bad sign. I usually try to get rid of such companies. The dividend cut could have been predicted several years ago, and it would have been wise to sell the stock back then. But let's start from the beginning with the report. We'll gradually look through it, and I'll provide you with the most relevant information. If we compare Q2 2023 with Q2 2024, we see a revenue decline. The company's revenue has actually decreased slightly, which is not just stagnation, it's a decline. This is certainly not a good indicator, which is why the stock drops so sharply. Now let's look at the report itself and what it tells us. Net revenue $12.8 billion, which represents a slight decline of 1% compared to the same quarter in the previous year. $0.38, indicating a loss for the quarter. $0.02, showing a modest profit when adjusted for certain expenses. Gross margin 35.4%, down from 35.8% in Q2 2023, reflecting challenges in maintaining profitability. Net income loss attributable to Intel $1.6 billion, a significant drop from a profit of $1.5 billion in the same quarter last year. 15.3%, a decrease from 7.8% in Q2 2023, indicating increased operational challenges. Cash from operations $2.3 billion, demonstrating the company's ability to generate cash despite the losses. To enhance its operational efficiency and market competitiveness, Intel is implementing a series of strategic measures. Cost reduction plan. Intel has announced a comprehensive $10 billion cost reduction initiative aimed at improving operational efficiency. This plan includes a significant reduction in spending across various departments. Headcount reduction. The company is undertaking a more than 15% reduction in its workforce to resize and refocus its operations, which is expected to streamline processes and reduce costs. Operational realignment. Intel is restructuring its operations to create a more agile and efficient business model. This includes separating financial reporting for Intel Products and Intel Foundry, allowing for clearer visibility into each segment's performance. Investment in technology. Intel is focusing on advancing its technology, particularly with the launch of its Intel 18A process, which aims to regain leadership in process technology and improve product offerings. Addressing the dividend suspension starting in Q4 2024. Intel has made the decision to suspend its dividend starting in the fourth quarter of 2024. This decision is part of a broader strategy to prioritize financial stability and liquidity. Here are the key points regarding this suspension. Focus on liquidity. The suspension of the dividend is aimed at preserving cash flow to support necessary investments in technology and manufacturing. Intel recognizes the importance of maintaining liquidity to execute its strategic plans effectively. Long-term commitment. Despite the suspension, Intel has reiterated its long-term commitment to reinstating a competitive dividend once cash flows improve and the company achieves sustainably higher levels of profitability. Strategic investments. By suspending the dividend, Intel aims to allocate resources towards initiatives that will drive long-term growth and shareholder value, including investments in research and development and operational improvements. Overall, Intel's financial highlights for Q2 2024 reflect a challenging environment, but the company's proactive measures and strategic focus aim to position it for future success and recovery. I've prepared the most important information and will provide you with a summary. With the report covered, let's move on to the stock itself. To keep things concise, let's address the volatility. As we can see, volatility increased significantly before the report, and it hasn't really decreased much after the report. If we look at the longer expiration dates, we can see that volatility remains elevated. I'm saying that volatility typically rises before a report and should decrease after it, but that hasn't been the case here. For some expiration dates and strike prices, volatility even increased slightly. This is interesting and worth noting, and it's definitely related to the drastic decline following the report. Now, let's take a look at the volatility smile. In this case, the situation is much better. We see that the volatility smile is tilted both towards the downside of the stock and the upside, meaning both towards call options and put options. The smile is increasing towards the growth side, which is actually a positive sign. The stock has fallen so significantly that natural investors and traders are leaning more towards growth. It's possible that some people are selling their previously bought put options, which is why there is no skew towards puts. Normally, the volatility smile is skewed towards put options because investors and traders hedge their positions. However, in this case, the hedging might be happening in reverse. There are a lot of short sellers, and those shorting the stock naturally hedge by buying call options. We can also quickly look at the short interest level. As we can see, it's at 2%, which is actually quite low, almost negligible. However, I believe the short interest has likely increased recently because these figures update more slowly than what's actually happening in the market. Returning to volatility, we see that the smile of both historical and implied volatility is currently at about the same level. Naturally, historical volatility has also spiked, which is related to the recent drastic drop in other recent events. But these volatility levels will gradually decrease over time. Now, let's look at the most important aspects, the trading volume of options and the support and resistance levels. We see that there's a large concentration of volume at the $22, $21, and $23 levels, which is where the most recent volumes are concentrated, particularly for call options. This suggests very strong resistance levels here. The largest support from put options is at the $20 level, and we haven't even reached that level yet. However, I can tell you that these levels are often tested. Market makers tend to test these levels, so I can predict that at some point we may touch this $20 level. After touching this level, we might see some kind of bounce upward, but it's unclear how high that bounce might be. We'll have to monitor the volatility of call options to determine that. Currently, the levels to watch are $21, $22, and $23, so the bounce could potentially reach $22 to $23. We'll have to wait and see. As for the trading volume, we can also look at the open interest. However, interpreting open interest requires caution because there are open interests at $30, $35, and $40, but these figures may not necessarily indicate anything significant. Now let's look at the market forecast. Naturally, the earnings report has been released and the market has priced in all available information. Now, the market is forecasting a price range of $22 by mid-September, which is not far off. It will likely fluctuate within this range. However, if we look towards the end of the year, the market is predicting a range of $18-20. This suggests that the stock could continue to decline further, which is likely tied to the anticipated recession. I expect a recession, and I believe the markets will drop significantly, possibly starting at the end of 2024 and continuing throughout 2025. The outlook for the markets could be quite bleak during this period. I'll continue to discuss and demonstrate these developments as they unfold. Now let's look at the stock price itself. As we can see, the price has already dropped below its 2022 levels, and it's even lower than the significant drop during the COVID-19 pandemic. Currently, the stock is trading at levels last seen in 2012 to 2013. In fact, if we look back during the 2008 financial crisis, the price was roughly at this same level. Essentially, if we consider that the stock first reached this $21 range in 1997, we can see that if you had bought this stock back then, you would have made practically no capital gains. Although you would have received dividends, which Intel paid quite generously, the primary reason most people invest in the stock market is for capital growth, with dividends being a nice bonus that can provide some income. However, dividends alone won't make you extremely wealthy. True wealth comes from the organic growth of the business in the stock market. In the early 2000s, the stock experienced a boom during the era of computers and the rise of the internet, reaching its historical highs. However, it hasn't been able to surpass those highs for 25 years. Currently, the stock is 72% below its all-time highs. This could serve as a cautionary tale for companies like Nvidia, which could potentially face a similar fate. I'm not joking because, as we can see, this can happen. What I want to say is that Intel is not a junk company. In the early 2000s, they were a leader, a real monster. No other company could even come close to them. Apple wasn't even a consideration back then. If we look at the stock from 1994, it grew by 2,000%, and if we go back to 1990, it grew by 4,000%. So Intel was truly a powerhouse, a locomotive of the industry. But that was in the past, and much of that power has faded. As a consumer, I'd like to share my personal opinion. Currently, I have an Intel processor in my system, which I bought quite a while ago. It has 12 cores. However, my next processor will likely be from AMD because Intel's reputation in processors hasn't been great recently. We can also discuss graphics cards. As far as I know, Intel's graphics cards are simply not up to par. They are practically non-functional. But again, I don't mean to offend anyone. If anyone out there uses them, feel free to share your thoughts in the comments about whether you like or dislike their graphics products. From what I've heard, the quality isn't very good. But again, I'm not an expert specifically on Intel's graphics cards. I just try to keep track of all stocks and products. If you're a professional, you need to have a general understanding of what every company in the S&P 500 does and what their flagship products are. As far as I remember, Intel does have graphics cards. But again, if I'm wrong and maybe they actually have a great flagship product, let me know in the comments. I might even consider buying their graphics card if that's the case. I also came across an interesting story on Reddit. Someone shared how they invested $700,000 in Intel and ended up losing a significant amount. Whether this story is true or not, I can't say for sure. And it's not really the point to investigate whether it is. What's important is to look at this as a cautionary tale, a general example of what can go wrong. The obvious mistake here is a lack of diversification. This isn't even about hedging, it's a basic principle of investing. In this case, it would have been simple to hedge by selling call options. But of course, it's better to avoid situations like this altogether. First of all, it's generally not recommended to invest more than 10% of your portfolio in a single stock. Secondly, it's not advisable to invest the full 10% all at once. It's better to buy in increments. You can read the book The Mathematics of Money Management for detailed guidance on how to beat the market using mathematical strategies. In this case, the person made a common mistake by investing everything into one stock, likely hoping it would jump from, say, $29 to $30 or $35, turning their $700,000 into over $1 million. But it's never that simple. As a professional, what would I recommend in such a situation? Let's assume the scenario where you have a portfolio with $700,000 invested in Intel, and you're not allowed to sell it. In that case, what would I do? Without hesitation, I would sell call options against the position. Let's break this down. If the stock was trading around $29, I would have sold call options at the $30, $31 strike price. While I wouldn't have made a massive profit from the report, I could have earned a decent premium. Let's assume hypothetically that I would have sold options, carefully choosing the expiration date by calculating the potential returns. It's possible that I could have received around $100 for each option sold, which would be a reasonable amount. So I would likely have sold the $31 strike call option and chosen an expiration date that would offer me a $100 premium, probably around 30 days out. Now let's calculate the potential returns. The person bought $700,000 worth of Intel stock at $29.50 per share. Here's the math: $700,000, $29.50, approximately 23,729 shares. Since each call option contract covers 100 shares, divide 23,729 by 100, which equals, if I sold 237 options at a premium of $100 each, that would result in $23,700 in premium income. It's possible to adjust the strike price slightly or select different expiration dates to potentially increase the premium, potentially earning around $25,000 in total. Clearly, the person lost more than $25,000, but they could have earned extra money by selling these call options. This approach would have helped mitigate the risk of significant losses. Additionally, I would have likely considered implementing some spreads as a hedge to further protect the position. Obviously, buying naked put options before an earnings report is risky due to high volatility, so I would most likely have opted for buying put spreads instead. Here's how I would have approached it. I would have chosen relatively far out of the money put spreads, such as a $27, $26, or $27, $25 spread, and bought more of them to hedge against potential losses. If I wasn't sure which direction the stock would move, the key would be to hedge such a large position effectively. If the stock price increased, the options would expire worthless, but we would still profit from the stock's rise. The primary goal here is hedging. So let's calculate how this might work out. I'd likely buy around 500 contracts for a spread like this. With a position as large as $700,000, 500 contracts would be reasonable. Here's the math: if each contract costs $100 and I buy 500 contracts, that would yield a potential payout of 500 contracts, $100, $50,000 in profits if the stock drops to the spread strike price. The cost for this hedge could be around $10 per contract, so $10, 500 contracts, $5,000 in total cost for this hedge. Thus, for $5,000, we could have hedged the position and protected against a significant downside. If we were willing to spend more, say $10,000 on this hedge, we could buy 1,000 contracts, which would provide $100, 1,000 contracts, $100,000 in protection. Combining this with the $25,000 we'd earned from selling call options, we would have a solidly hedged position. This is how I would have managed the situation given that I was required to hold the portfolio without selling the shares. This approach would effectively hedge the position and potentially generate income while protecting against significant losses. Naturally, if the stock had risen sharply and if dollars were burned, but again, the entire growth of the stocks with such a large capital would not offset those $10,000, because for such a large capital, $10,000 is actually not a lot. The main question is, what should this person do now? How to play it? Actually, $500,000 is very, very serious. It's a lot. Using derivatives options, one can steer the situation very calmly. So apart from the fact that the stock can rise, yes, one can play this case well by means of quite competent management of derivatives and options. Let me once again assume in front of you how it could be done and how I would do it. For this, we need to look at what is happening with the options, what our delta is. I also remind you that today is a weekend, and naturally our data is not accurately reflected. Let's look at the premium. So the premium for the 20th strike is $100. Fine, but we need to start with call options. Call options are actually expensive now, but let's look at their average price. The average price is $30, so purely hypothetically, we can safely sell options with a strike of 30, and we won't lose on it. I am calculating this again for options, therefore we can safely sell, for example, the 29th strike, absolutely not worrying if he has 23,000 shares. Naturally, one can sell more options, much more options than he has shares, because we would be selling options according to the delta. If our delta here equals 0.076, then we can sell 10 times more options, but of course I wouldn't take such a risk, because here you need more serious management involving a serious algorithm. We can just sell, for example, 1.5 times more options, although even that is a lot. We can sell slightly more options. If he has 23,000 shares, we can sell 230 options, and for each option, we will be paid an average of $13. Naturally, we multiply by 13, and that is also $3,000. Yes, he lost a lot, much more, but again, we have already reached such a situation. In any case, $3,000 is still better than nothing. Therefore, we can at least start doing this. We will have dividends plus option sales, and naturally, over some period of time, he writes here about 10 years, but again, if we manage options competently, we can steer the situation even in a year. That is, if the stock, for example, doesn't move and stays in about the same range, recovering 30% in a year is quite possible. We just need to manage the options competently. But again, I always talk about this, and here I just became interested in this story. Following such stories is actually interesting. Well, naturally, I would never advise you to take such risks because it is really very risky. Also, I remind you that I am leading a completely new portfolio absolutely from scratch, and there I show how I form it. Don't worry, I don't build a portfolio from one stock. I will have 10 top-notch stocks. By the way, several of my stocks, despite the market falling, for example, this stock that I showed in the previous video, has actually only grown and increased by 15% over the past few weeks. Unfortunately, I didn't manage to buy it, but the essence of a top-notch stock is that we don't worry and everything is going great. So be sure to watch my previous video, leave comments if you have any questions. Good luck to everyone.